There's going to be a recession. People are going to lose their jobs. The markets are going to get roiled up. And a smart investor always wants to have dry powder, especially during a recession, because at the end of it, there's probably going to be some opportunity there.
Here at Liberty and Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
Welcome back to Liberty and Finance. We have a first-time guest today, and this guest we got connected to through our good friend, Gregory Mannarino, the founder of TradersChoice.net. We're speaking with Chuck Barone. He is a mortgage banking expert, and he's going to talk to us about the real estate market and the mortgage market. Those are things that are really on a lot of people's minds, because in this so-called bubble of everything, which included stocks, bonds, and real estate, the real estate portion of that has been a very significant component of most of baby boomers, late career stage, or retired net worth. And a lot of things are happening. People are trying to find homes and having a hard time, my wife and I included. Chuck, thank you for coming on Liberty and Finance for this first time.
A pleasure to be here. Thank you for inviting me.
I want to let everybody know we're recording this on Friday, July 1st, 2022, and delighted that you're able to join us. You and I were talking earlier about how you've been in the mortgage industry for nearly 30 years, and before that with Lehman Brothers and so on in the equity markets. Can you let us know what you're seeing now that people need to be aware of as far as major changes that you see happening from leading indicators in the, let's start with the real estate market. The real estate market, no secret to anyone, has been on an upward tear for a long, long time. In the last couple of years, I can personally vouch it's been a seller's market. My wife and I have been trying to relocate, and with no success yet, we've put in offers on numerous properties, always to be outbid by others. The most recent time, we thought, well, let's just get into the target area by becoming renters initially, and then we called up one of the places that had a place for rent, and they said, well, we already have a application that's been filled out at above asking price for rent. So if you want even to have your application considered, you've got to bid higher than this other renter who's already bid higher than the asking price. So to me, it seems like for some time it's been signifying a frothy top of the real estate market, but it's always hard to call tops and bottoms. What are you seeing from the leading indicators that you watch very closely in the real estate market, I guess in your area and nationally within the U.S.?
Well, my area here is in Las Vegas, which is a lot of times a leading indicator for the state of the real estate market across the country. Usually when there's a big boom, we're near the top of that. Usually when there's a big bust, we're near the top of that. I've been talking to people for a while about how overheated I believe this market is. And I've been doing loans in this town for a long time, from back in the days when loans were a simple thing. You were either a government loan or a conventional loan. It was a simple process. Now to going through the early 2000s with all the crazy loan programs they had then the big bust, now the big reboom, and it's just completely unsustainable, Dunnigan. I was just doing some simple math. Now here in Las Vegas, I'm a mortgage broker. I do loans still every day. I'm not a professional YouTuber, and I've just seen literally a complete collapse in our business here. We usually do quite a bit of business every month, and it's, I would say, down 90% from what we're typically been doing. And the reason is simple. Mortgage rates, when you combine them with the high prices, make people who want to finance a house not be able to. The payments that you come up with at these with these prices and these new rates, people can't qualify for the loans anymore. I probably have a half a dozen people who were trying to buy houses and couldn't buy during the boom because they couldn't pay $25,000 or $50,000 overappraised. Now that's kind of gone away, and now they can't buy because they can't ratio for the payments anymore. So it's just the saddest thing I've seen, where you have people who are qualified to buy and can't for some odd reason that has nothing to do with their qualifications to buy a house. So what I did was I did some calculations, and I calculate that if you took a $450,000 median price with a typical 5% down payment, okay, when you factor in taxes and insurance, you got a payment there of about $3,300 a month, which for the vast majority of people they can't afford it. It's more than 50% of their income. They can't even get a loan at a payment like that. So I got to work with my calculator, and I tried to figure out where prices would have to go where people could ratio and payments make sense. And I'm seeing it even at $300,000 purchase with 5% down, you're still looking at a payment of over $2,000. So for the numbers to make sense, I see prices are going to come down pretty dramatically. We're essentially going to give back this giant year gain of almost $100,000 that we had in this market. And hopefully when it's all said and done, although equity will get trimmed off a lot of people's houses, and we'll even have some people upside down again, people will be able to proceed with buying houses, and it won't be just a cash buyer or a corporate buyer market that it's been for the past month or so.
Yeah, that was another phenomenon that we ran into looking in Central Florida for a relocation property, is that we found that even some of the rental homes we were looking at weren't owned by individuals. They were owned by nationwide corporations. You couldn't get a hold of anybody to ask questions, and gave us a chill, thinking, gee, if you actually lived there and you had some maintenance problem or something and you can't get a hold of anybody because there's no local accountability kind of thing, how does that work? You talked about how Las Vegas, where you live and work, is often a leading indicator for the nation. There's probably several factors behind that, but our national article did come out in the Wall Street Journal today. I'll hold this up. America faces a housing bust, and they talk about this is a big trend they're seeing the cusp of. Can you talk to us about that national phenomenon and how that typically follows? I mean, how far of a leading indicator is Las Vegas typically ahead of the rest of the nation, and what do you see unfolding going forward here?
Well, we usually lead the parade all the way up and all the way back down again. This housing bust they're talking about, what's happened is, the sellers, as you mentioned in your opening monologue, it's been a seller's market forever. So these sellers have had a giant advantage, and they've been bumping prices up, and buyers have been willing to pay it, especially when you have the corporate people in the market as heavily as they are. What's happening now is, since people can't afford these payments anymore, people aren't trying to buy houses, and that's why you're seeing competition for rental properties, where people are outbidding each other to pay more rent on them. That's why we're really going to see, I think that this correction is going to happen pretty quickly. We're already seeing the cracks in the dam as far as new construction permits, houses that are listed, existing housing. They're already reducing prices pretty dramatically here in Las Vegas. We had a housing supply, which is a real indicator of a market. They say a 6-month supply is a neutral market. Anything less than that would be a seller's. Anything more than that would be a buyer's. For the last 6 months or so in Vegas, we've had less than a 1-month supply, sometimes as little as a 2-week supply, which just so when you couple that no supply with the big demand we had, it just drove prices through the roof. People were doing the craziest stuff, and I tend to be a little more conservative than most people, and I don't know how anyone in good conscience can recommend a customer pays $25,000 or $50,000 more than the house is worth just for the privilege of buying it. You're going to give away your first however many years of equity just to own this house. It really didn't make a lot of sense to me the way the market was going. So now we're in a natural correction. It's when you have these manias like we had back in 2008. We're seeing basically the same thing again, except the situation's different. Why it's coming back down, I don't think it'll be as dramatic of a correction as we had back then, but prices are going to come down. There's no ands, ifs, or buts about it.
And at the same time as this is happening, there are sweeping changes happening in the mortgage markets as well. It's very curious to people who are in the cheap seats that without even way ahead of the Fed raising interest rates, the mortgage rates already anticipated and moved from high 2% rates, just under 3% up into like the 6% range, even though the Fed only raised whatever 0.75%. So can you talk to us about what you've been watching in terms of the trends of mortgage interest rates, and then maybe contrast that with what you've seen in previous cycles of similar magnitude that have happened in the past, and what kind of timeline those usually play out over?
Well, the mortgage market is typically going to follow the 10-year. So when the Fed announced their rate increases, and they were pretty dramatic, that caused the mortgage rate to spike pretty good. And add in, you can never underestimate the greed of bankers either, right? And so the mortgage rate spiked up to 6%. They've been trickling back down now to about 5.75%, along with the 10-year going down, which is a phenomenon. That's another story. I think that with the Fed's plan, we're going to have to see whether the Fed's going to have to make a choice here, I think, Dunnigan, where are they going to really fight inflation and do the things they need to do to fight inflation, which in my opinion will cause a pretty dramatic recession, or are they going to give in to inflation and try to save the economy and keep the economy going and everybody learns to live with these outrageous prices? It's really a Hobson's choice, but they're trying to finesse it and do the Wallenda family tightrope walking. It's not going to work. So we're going to have to see which way it falls. I have my doubts about the Fed's 3/4 interest rate increase next month. I think they're already getting a little squishy on that. They saw what the first one did to the market and the way the market reacted. So it's going to play out pretty interestingly, but I believe the correction will be a quick one. I think that sellers of existing housings will lead the price mark down. In some places in Las Vegas, they already have reductions of up to $40,000. And this is just at the very beginning of it. And the sad news is for those people, even with those reductions, the houses aren't selling. So I think it's going to be a pretty dramatic slide. I think it's going to happen pretty quickly. I think when we get second quarter GDP, it'll confirm we're in a recession and people are going to behave accordingly. So the psychology plays a big part in all of this too, right? It's always a phenomenon to me that everybody is rushing to buy when prices are at the very top, but nobody wants to buy a house when they're at the very bottom. It's unbelievable. In 2012, when the dust finally settled from the big kablooey in 2008, the median price in Las Vegas was $118,000 in 2012. Nobody wanted to buy a house. So, of course, the corporate interest came in and people moving to town, so the market developed. Well, we quadrupled our price in 10 years. That's really not how real estate's supposed to work. It's not really supposed to be as speculative as it's been. We have this phenomenon now of these house flippers in the market. I've seen at least 10 TV shows about people doing it. I think that the professionals in the market will do okay with this flipping, but I think there's going to be a lot of amateurs who thought it was a way to get rich quick. We're going to get stuck holding the bag now as prices come down pretty dramatically.
Could we look at a couple of examples in theory? One would be somebody who's been living in their house a long time. They're considering whether they should consider selling in the current environment or whether they should hold out hope that the housing market is going to continue its upward march that it's been in for such a long time, as you mentioned, since 2009, 2012, after that correction. Again, we don't give personalized financial advice on this channel, but for people who find themselves in that general category of homeowners who were contemplating whether this would be a good time to sell their home, what should they be thinking about at this point? And then we'll think of some other examples of categories of people after that.
I think it depends on why they want to sell. If they're selling to downsize or to upsize, something like that, they always say there's never a good time to buy real estate, right? It always seems too expensive. If you're a speculator or you have investment property you want to sell, now's the time to do it because I think prices over the next year or so are going to be down, down, down. So you're probably going to get, even though you may not get as much as you hoped for by selling today, you're going to get more today than you will tomorrow. That's for sure. And if you're selling for for upsizing or downsizing, well, that's a tough one because if you sell your house for top dollar, the house you buy is going to cost top dollar too. If you sell your house on the way down, well, you might not get as much as you want, but you might be able to catch a bargain on the buy side. So it's really a tough way to play it right now, Dunnigan. It's hard to give really good advice on it because there's just so much uncertainty. How fast will prices come down? Will the Fed, will the spineless Fed lose their spine, what little they have of it, and, not raise rates the way they've been promising and actually see a recession, get a confirmed recession, and think they better start cutting or ease off on raising rates. So it's really difficult to have an informed opinion on that. Again, I think the biggest factor would be, why are you selling the house? Speculators, get out now. People who are selling a house they live in to buy another one to live in, that would be something I would like to have them across from my desk for, to kind of really have a conversation with them about what their plans are, how long have they owned the house they live in, how long do they plan on living in the house they're going to buy. There's so many different factors that go into play in that it's hard to really give a good definitive answer.
When you mentioned earlier about mortgage companies, you said you have to give them the benefit of the doubt in terms of that they may be trying to make an extra bit of premium there during rising markets. One of the realistic concerns as a business is that if you're going to stick your neck out for 30 years and say, I'm going to lend you money at this dirt low rate for 30 years, but it looks like that the political environment is going to be one of increasing rates, that's real exposure of comparative loss for that business. So for that might be part of the answer. I think that's where you were going, was that even though the Fed had only actually raised a fraction of a percent, why mortgage rates could double from 3% to 6%, it seemed like that's in anticipation of the potential future costs or lost opportunity costs of the mortgager who's going to be extending that amount for that long period of time. It's got to be difficult for those companies, but if the Fed starts to rein in its horns and maybe not signal or actually indicate that they're not going to be raising the rates, do you see a potential for a dramatic downturn, or do you think downturn in mortgage interest rates again, or do you think that they'll remain high just out of the uncertainty, just because the mortgage lenders have to hedge their bets and can't expose themselves to what had been promised previously by the Fed years, as far as the eye can see, we're going to be near zero rates, that kind of thing?
Well, you're kind of exposed to market risk and interest rate risk if you're a lender. You have the possibility that rates could go higher, and you know how that works, right? The teeter-totter. So if rates go higher, the value of your paper goes down. Then you have market risk because you're having a recession coming, and it looks like, from what the statistics I've been reading, we're already seeing delinquencies in car loans and credit card payments and consumer debt. It's not long before that trickles into lates and mortgage payments. When people are having difficulty buying the necessaries, food and gas and the things they need to provide for their family, well, now you're looking at real market risk where you could have some people walking away from houses, or, because I think we're going to have that phenomenon again where people are upside down. The people who bought recently and paid $450,000 average, when that market comes down, are going to be underwater. They're still going to be sitting on a high payment. I think you might see some people walking away from houses, like we saw back in 2008 and 9. So lenders are going to price that risk into their rates. And I think that's a big part of the reason you're seeing rates not only that, rates have a tendency to go up quickly and come down slowly, kind of like gas prices, right? The price of oil goes up a couple dollars a barrel and boom, it shows up at the pump. It comes back down a couple dollars a barrel. Where's the discount? You don't see that. It kind of works that way with interest rates as well. They're a little more reluctant to lower them than they are to raise them, that's for sure.
Let's look at another case study if we could, and this would be for someone who's seeking to buy a home. After COVID, lockdowns were expired, a lot of people made their move that they couldn't make during the lockdowns, and many people went into larger homes because now they're working from home, or they realized that the home was going to be a center of their life, or that they were living in the wrong part of the country, that they didn't want to be in a place that was very authoritarian or tyrannical or whatever. They wanted to be someplace more liberty loving and freedom protecting or constitutionally oriented. So there's been this big shift, people doing strategic relocations in a big flurry. So for people who are house shoppers at this point and are wondering whether they should keep their powder dry in anticipation that there may be better deals coming in the next quarter or two or three, again, not personalized financial advice, but general principles that you would talk about with someone who is a house shopper in the current environment as far as the timing potentially of their making their move. If they're going to make a big commitment to take on a big mortgage, what your thoughts would be for them.
Well, I mean, just again, all these circumstances are always so different, but my thinking would be to keep your powder dry right now. It's obvious there's a correction coming. I think that even if the Fed keeps rates where they are and mortgage rates stay where they are, we're going to see a pretty dramatic correction in the real estate market. I think that if the Fed continues to raise rates and those increases are reflected in mortgage rates, it's going to get even deeper. I think that you'll be able, depending on what your living situation is now. Some people have urgent reasons they need to buy a house today. If that's the case, buy the house. Just be prepared to stay there a little longer than you might plan, because the value of that house is going to kind of V out like it did from the last one. And it may not rise as quickly as it did these past 10 years. So if buying a house, again, I go back to my own conservative nature. I'm as old school as it gets. I believe you buy a house to live in it, to ultimately pay it off. That doesn't seem to be the mentality in the country anymore. The average life of a loan, although it's longer than it was, is still under 7 years. So typically within 7 years, people are either selling their house to buy a new one, upsizing or downsizing, or they're refinancing to reduce payments or take cash out for home improvements or whatever. So again, if you don't have a lot of urgency and you can afford to be patient, I would say do it, because it'll pay off down the road in a much better deal. And nobody wants to buy a house for $400 and then 6 months later it's worth $350. That's no fun.
And one more case that I wanted to mention, but I think you already brought it up in passing earlier, and that's for people who have been speculative, non-residents, but owners of multiple properties, perhaps that kind of thing. I know I met personally a gentleman about a month ago who has accumulated over time, well above 100 rental properties, and he said he was trying to just liquidate all of them. When he talked to me about this about a month ago. So again, just recapping for people who may be owners of either Verbos or Airbnbs or multiple rental properties, that sort of thing, your thoughts for them in the current environment.
Well, I would lighten up my load, especially if it's leveraged. These payments are going to keep rolling. There's going to be a recession. People are going to lose their jobs. The markets are going to get roiled up. And a smart investor always wants to have dry powder, especially during a recession, because at the end of it, there's probably going to be some opportunity there. So I think that the prudent investor right now would be lightening up his load, selling some properties, when probably, if he's prudent, was selling into some of this rally earlier this year. The smart investors typically do, right? It's like when the price is booming, somebody's selling. That's usually the smart money, right? So I think that you may be a little bit late to the dance as a seller right now, but you're still going to get more money today than you will next week, next month, 3 months, 6 months from now.
I wanted to underscore something you just mentioned about the potential for layoffs. People may not have been hearing that. There were several stories that came out just this week about Tesla going to do white-collar layoffs. Netflix has been doing layoffs. A whole litany of very successful companies. If you think of kind of the flagship, high-flying companies that were growth companies, darlings of the last 3-4 years, are now doing significant blocks of white-collar layoffs. And the article was talking about just this bifurcation of the labor force, where blue-collar, highly skilled craft-type workers are going to be in high demand and shortage, whereas white collar labor, which can either work from home or can be offshored, work from overseas or whatever, are going to be considered a unaffordable cost on the part of many American businesses, and they're going to be lightening up their load on knowledge workers. So that's a lot of these. When you talk about the median home price, we're talking about some of that even above median white collar jobs that are slated for being axed by some of the most high flying companies out there currently. Your perspective on that in terms of the looming prospects for major white collar layoffs?
We're already seeing that in banking, real estate, mortgage companies. A lot of manufacturing has been down. You mentioned Tesla, Coinbase, Netflix. The list is a long list already of companies already starting to lay off. I think this is like the small snowball at the top of the hill, because once these things start to gain momentum, they really start to roll. And unemployment is so low right now. People are shocked that unemployment could be 5, could be 7, could be 8%. Well, think back to the last recession. Where were we unemployment-wise? It was pretty ugly. I don't know if it'll get that bad again this time. I think we're going to have a pretty serious recession, but probably not the shock and awe we had back in 2008 and 9, where literally the entire banking system was ready to collapse. I don't think it'll be that bad, but real estate's certainly going to be one of the areas that gets hit the hardest. And the layoffs coming, again, as you mentioned, this is white collar guys now. So these are the guys buying the really big houses. And I've talked to a few people on my blog and talked about it in my blog. I really believe the correction, the bottom of the market, will probably stay the strongest, where the first-time buyers are trying to get in. The top of the market, these ridiculously priced $1 million houses that should be around $600,000, those are the guys that are really going to eat it coming up.
One more topic before we wrap, and that's this idea that you've introduced earlier about, you said that you tend to do it old school, you tend to play conservative, you tend to think about paying off a mortgage. Can you talk to us about principles that people who really want to reduce financial risk to their family in these volatile times should seriously consider taking on, so that they can not only survive but thrive in the however volatile the financial times are that are coming ahead of us?
Well, again, I've talked about this a lot in my blog. I think that you need to be very prudent and thoughtful with your money. Try not to be impulsive. Try to do the best you can right now to save as much as you possibly can. I think there's going to be, at the end of this recession, there's going to be opportunities, and the people who have money put away are going to be glad they did, because not only will it help them get through the recession, but it will provide them the opportunity to take advantage of some of this stuff that's going to happen after, some of the good things that are going to be available. I think that, if you have a portfolio in the stock market or however you're invested, take a good look at that portfolio. Try to get yourself in a more, especially if you have a lot of speculative stuff, tech stocks and stuff of that nature, try to get your portfolio in a little bit more defensive position where you can weather this storm a little bit better. And a lot of people ask me what that means. I would say blue chip, high dividend preferreds, blue chip consumer non-durables, soap and food, gold and silver to preserve value in case the dollar does have a little bit of a big dip, and then the rest in cash to hold tight for the opportunities that will present themselves. Because there may even be opportunity during the recession that, think of how it works, right? If you're a person who wanted to buy a Rolex watch, for example, and you were ready to pay $8,000, $10,000, whatever the number is, well, you might be able to, during this recession, get that watch for $4,000, right? So there's going to be a lot of opportunities outside of ordinary investment opportunities where you're going to be able to get the things you wanted today for a much better price tomorrow.
Well, Chuck, you have just launched your new video blog on YouTube. Your channel went from 0 subscribers to, I forget, 15, 17,000, some great number, and rising astronomically in a very short period of time, thanks in some part due to the endorsement you got from our mutual friend, Gregory Manarino. Can you tell people where to find you online if they do want to subscribe to your channel? Sure.
Just go to YouTube and type in my name. It's Chuck, C-H-U-C-K, Barone, B-A-R-O-N-E. It should pop up pretty quickly in the search. Our friend Greg has been just so generous and so helpful. It's to give you one last story before we break today. Greg and I talk finance all the time. And he's been telling me for months that people need to hear what I got to say because I have a perspective that's a little bit different than a lot of people's. I'm a little more conservative. I'm not going to be the rah-rah guy for all this speculative stuff. And this is the perfect time to hear from a guy like me with all of this turmoil in the markets. So when I finally agreed to do it, he put his support behind us 100%, has been there backing us and helping promote the channel. And I couldn't be more grateful. This is the true sign of a friend that's willing to share like that. A lot of guys wouldn't, right?
Well, that's one way that we can help each other. We talk about that a lot on our channel. I know Greg talks about that, about helping each other, is in this time when it seems like the powers that be that are directing the course of actions that affect our lives do not have our best interests at heart, whether it's in destroying the value of our currency, destroying our ability to earn whatever interest in savings accounts, or all kinds of things, loss of privacy, increased taxation, and so on, restrictions. In the face of that, we can step away from that to an extent by focusing our efforts on ways that we can help each other. And this is one way we're trying to do that, by networking, getting people the information that they need so that they can make the best decisions possible to help support their family. So we've been speaking with Chuck Barone. He's a financial and investment and especially mortgage expert. He's joining us this first time ever on Liberty and Finance. Chuck will put a link to your blog in the description of this video so people can click over there and get subscribed right away. And we just thank you, and I thank you on behalf of all of our viewers for joining us this first time on Liberty and Finance.
I'm really grateful for you having me, Dunnigan. Thanks for the invite. Much appreciated.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.